And good afternoon. We are watching how LCID opened. That's the open of the market. That's the pre-market on market profile. Now we watch when a stock opens. I'm playing this 10 times speed. You want to watch and see. Those are the upper and lower stops. So we opened, ran the upper stops of the previous day, came back in. Now that's usually what we call a gap and trap. The market opens, moves up higher, comes in. It's not a real gap, but it's a move up, sell inventory. Now as we'll come down to this level here, right? That level is where the stops will be. So you let the market go back and forth and you can see everything with market profile. You can see all the volume and all the action. I have this set to a 3 tick. So every one of these increments is 3 cents, right? So now you see how they're running the stops to get supply. Look at the size. Do you see the size there? Beautiful size. That's accumulation by large size traders. Once they accumulate all of that position, they are going to try and get as much of these people's supply as possible. This is stock trading, right? So you know that there are stops at that G low, the F low, and the ultimate ones will be D and A. So now they're going to run that F stop. You see, every time you take a stop, it's like you break a piñata and the candy falls out. Then the size traders start buying here. So if you can't break 36, right, to the downside, you know that this is just inventory from the other day selling out. You're taking everybody's stop, so they have to sell. Large traders are buying that. The people who are inside the deal are controlling supply. So they're not pounding on it here. This is what we call cleaning a market after you've taken it higher. So this way we go sideways. We clean the market out very, very nicely here, right? You can see the market coming in, coming in, coming in. Then you see that responsive buying. Shorts are starting to realize that, oh, it's not going to break that low. So they start to cover. Some of the traders who buy here sell. That's how we get that ebb and flow. Now the market starts cleaning up and we'll start looking for 36.90. So if it holds 36.60, we start looking for higher, right? And our stop would be at the bottom of that A low, right? So you just wait, give it some time. We're still in the first period. This is just a half-hour bar. All it is a candle that you open up and take a look inside. Once you open it up and take a look inside that candle, you can see everything that's going on, right? And this is how you can use market profile when you're looking at equities to trade, because these are the actual transactions. Now B period opens up. Now let's see if B period can go and take out the low of A. If B period, that low holds, you can go quick long off that low for scalpers, right? That's a market profile technique. You buy, you put your stop, that's your first target, and you're out before the target, right? You always sell into strength, right? Now the market's going to go back and forth while the large traders are looking at the order flow that comes in, right? We can tell what they're doing by, you can see that they've got position here, right? You can see the size, right? They're going to distribute some of that, right? You buy 10,000, sell 10,000, buy 100, sell 100. That's how people make money on the other side of this, right? That's how wholesale market makers make money. Now you can see that the supply is starting to dry up a little bit. You'll notice that will start creeping higher and higher. So that's why you don't initiate a short there. This is where you're looking for responsive longs. So you could be long 36.30, 40. Your stop would be under 36.10, depending on what your risk profile is like. Now the market's starting to turn up. Remember, we took those upper stops, but only by a couple of ticks. Now watch, we're getting close. Boom, stop run. Now we are creating what we call single prints. And if those single prints hold, we will have what we call a short position in the middle of the day, right? So now we've run the stops, we've created the buying, we're looking for 38.37, right? Boom, there it is, right? As the market drives higher, right, it's distributing what it bought lower. Now you look at this big chunk of volume and see if the market can come back in here. This is how you trade using structure. It will tell you where the buying and selling is. Look at the responsive buying as shorts are trapped, right? This is a short stop run. This is taking all the stops of the shorts. People chase FOMO long. And the people who bought it down here are selling it to them up here. It's a beautiful thing, right? Now we know the top of our range is 39.78, but we expect it to go back and forth and back and forth, and we'll just wait for the next period to develop. Now, if that next period develops and leaves what we call single prints, we know we have a short position in the market. And if we have a short position in the market, we have no business shorting it. We need to trade with the flow of business, right? So see, when they take out a stop like that, you must ask yourself, how short are the shorts, right? Look at the extension on this. It's just beautiful. Now you can take this and use this along with a candle chart, right? It helps very much to know structure. This is what we call backfilling. So if you're a short seller and you hit that, right, you watch that little red arrow. If that arrow can't come down to 38.37, you need to start wondering whether or not there's any supply. Now, what we do have is we have single prints, and you mark those off by just putting a rectangle here. And as the market gets into that rectangle, that is an area where buyers are, right? It's a short position. And what are shorts? They're future buyers. So anytime we get any selling, the market's going to come down and start trading through these single prints. If it cannot, that means there's no supply. You expect it to come and fill some of these and at least try and backfill and test 38.37. If this market can't get down, backfill, it does exactly what you're watching. Now it took my 39.78, came back in. You'll see the high is 39.80. We're close. Now it's going to backfill because it's created demand, and now we're introducing supply. So this is how we use market profile when we're trading. It's a very, very simple tool to use because it's all supply and demand. It is the most accurate form of order flow trading there is. You can't get any better than this because these are the transactions. They can't be faked or spoofed or smurfed or whatever you guys call it, right? This is all transactions. People are buying and selling. The transactions are leaving structure. Now you can see that they finally get a little bit of overhead supply. These people are trapped and they're going to sell, right? As their stops get taken. The stops are at the low of that C. So if that C gets taken, ooh, see, you get a stop run, right? But only one tick, 2 ticks, ooh, not that much, right? So that's what you keep on track, and you use that to determine how much supply you have. If we have lots of supply, this box will come and fill. If we don't have supply, the box will stand, right? And that's how you look at markets that are breaking out. This is also called one time framing, where the lows are successively higher, right? So what you guys would say for candle traders is trend up with no supply. Now we're going to get some supply. Watch, right? As it comes in, it's going to start taking some of this out. And that's expected. You're supposed to backfill the shorts. These are all buyers waiting to buy, but there's not enough supply to get down there and fill them, right? That's why the market keeps bouncing. And you can watch from this. This is called responsive buying. Did you see how it jumps? When that little red triangle comes down and it finds a big buyer, it jumps like it sat on a tack. Like if you sat on a chair with a nail sticking out of it, you jump up, right? Well, there's a big buyer right there, or a big group of buyers, right? Usually what it is in a stock is the people who control the supply, the insiders, aren't going to sell underneath 38. So every time the market comes down here, the big sellers refuse to sell. So this is just us, right? Now the next period opens up. If that C low can't break, right, there's supply. This is going to adjust the one-time framing, and D now is going to adjust inventory. See, look, it adjusts the inventory. It allows some of the shorts to cover, right? But as soon as it does, look at that responsive buying. Now, how do you trade this? You look to see if you want to get long, just over here, put your stop just at 38.37. Your first target is that D high. If they can run those stops, the market's going to rip up. If they can't run those stops, the market will come back down. See how they ran the stops? It's a beautiful thing. It's absolutely beautiful. And this is how you use market structure to tell you what actually is going on in a market. If people don't tell you you can't figure out what's going on in a market, they don't know what's going on. Have a great day. If you want to come check this out, we are at microefutures.com. We do equity sessions too. We cover crypto, equities, pretty much anything. If you can trade it, we'll figure out a way to help you make it profitable. Even if you want to trade cheddar cheese. Have a great evening. Bye for now.